Hi everyone, thanks again for tuning in to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group. As always, you can watch this on YouTube and our interactions as well as listen to it on audio. So I thought this is, off the back of the last podcast we did with Omar, just a bit more about the company and all that. So we're back into the groove of kind of looking at markets, particularly oil markets, what's been going on recently. So I'm joined with Audrey, Vincent, and Martha. And Audrey, what are you kind of focusing on today?
So I guess my focus has just been kind of looking at flat price this week, some of the key drivers there, and some thoughts kind of about, where new flows might come from, replacement of, the Saudi cuts, some rumors that were flying around yesterday as well. We can kind of dig into a little bit.
Okay, great. And Martha?
I just thought I would bring to the table a discussion about more kind of geopolitical aspects to the crude market in relation to the UAE and Saudi government tensions that have been re-stoked recently.
Mm-hmm. And Vincent?
Still about crude, yes, very boring. But yeah, I'll be talking about the curious case of the Brent versus Dubai crude benchmarks and what's been baffling the markets at the moment.
Nice.
Great. So, okay, bit of context. We haven't spoken in a couple of weeks, so I think, things dramatically changed, almost on a Friday before. Basically, it was the Brent expiry, wasn't it? The day of the Brent expiry, we had a bullish impetus from the back of even deeper cuts from the Saudis. And even though this is the same old, we did get a very severe short covering rally, or at least a rally, in both the dated Brent contract that was kind of weighing and looking very bearish, and the flat price Brent. So, and it's kind of been touch and go since, because we haven't sustainably surpassed 80. It's kind of reached a ceiling there. It's reached a ceiling on the Brent spreads. We kind of got to about 40-ish in the prompt, and now that's back down to like the mid-teens. Dated Brent's looking weak again, and we're kind of 78-ish on Brent. So, yeah, what were you thinking? I mean, I know you've been mentioning about the pricing in of the OPEC headline and things like that.
Yeah, so in the last podcast, I mentioned that I had seen this kind of rumor floating around that they were going to extend these cuts for the rest of the year. And then I remember at the time, Vincent saying you hadn't seen it and that it was definitely just for July. And then obviously they came out with August. And that's when I said, I know I've seen this before. And then what actually happened yesterday was somehow this article that was published. So on the 4th of June, when the Saudi energy minister came out and he was like, oh no, we're going to extend these cuts into 2024. Somehow that resurfaced yesterday.
Yeah.
And then the market just kind of, as Twitter and all
Sorry, you're saying that you did read that, but people
I read that and it went missing. And I couldn't find it. And then I looked ridiculous for misreading the legitimate source of information that were out there. But then this resurfaced yesterday. So it wasn't new news. It was a resurfacing of old news.
So it got deleted.
Yeah, and should have never been published in the first place back then, because it wasn't what they were saying. They were cutting for July and just July, and that they would reevaluate. And at the time, I remember saying to Vincent, I was like, do you remember me saying this to you? And you were like, I wrote it down in my flat price commentary. And you were like, Audrey, that's not true. And I was like, no, I read this. And then I couldn't find it. So then I was like, maybe I was I must have been having a really off day that I've just made up this.
That's crazy.
Cut. But I obviously, so me and some of the market, I must have, thought about this. But so this resurfaced yesterday on Monday. And then prices kind of ripped up. I think they hit like 80.56 on Monday. And then there was just whole, I think, actually Brent Dubai, I think, was ripping around quite a lot yesterday. I was talking to our Dubai trader and he was really busy in the window yesterday because of all this kind of rumor and everyone fixing and getting out of the positions once it came out. Yeah. That this was not true. This was fake news, or this was like a resurfacing. And yeah, really.
That's mental, because I did know that the announcement was made and then retraced, and then we got a pretty severe reaction up, but then it kind of just eroded back. So you could lose money in that period, but at the same time, I didn't realize that the Brent Dubai, though, that's pretty frustrating for these guys. So the real ramifications of a headline is that they need to go and fix physical off the back of this, thinking there's going to be less. So using the Brent Dubai differential to hedge the basis around Dubai, and then, oh, by the way, that's not true.
And then you've got to go and
that's real money.
Yeah, and prices. If you look at flat price, at 1.5% down yesterday versus Friday's prices. That's quite a big.
So this is a mistake by.
So we think I first saw it on Reuters, and then obviously just social media did what social media does. And actually, this is something we should talk about maybe in a little bit as well. Those kind of fintech bans, but we can talk about it later.
Well,
on.
Yeah, I mean, but it got redacted.
It did because it did officially get redacted,
and we can't even move the market and make people make decisions. I mean, that's
it's big.
That's kind of sue worthy. I mean, I'd be very frustrated. I remember when Platts came out with their 2022 like proposal for WTI Midland to be included in 2022, and basically, so this was a couple of years back, and they actually said, look, it's going to become a CIF contract. In other words, like every price that you're used to seeing as a physical differential to basically free on board, so on the location, so like around North Sea terminals, is now going to be CIF. So you basically got to add the freight component as well, the shipping to get to Rotterdam. So you pick up all the, so they just made this sweeping statement. It's like, okay, so now basically all the DFLs, all the dated Brent contracts, we now have to basically add $1 to it, or $1.50. It's like everyone who had positions on there just saw their Cal 22 positions just go woof. And then it was like, you could try and buy, but no one was going to sell. So if you were short, you got completely destroyed. But if you bought and then tried to sell higher, it was like, what do you do with those as well? So it was a complete, and we've seen this before in a long time ago, actually. Now it was a Gulf Coast contract, I believe. I actually can't remember exactly. I remember our trader, it was back in Mandara. It was changing spec the next year. And then I think either ICE or Platts or something just said, we're going to cancel all those contracts that traded, because so much had traded on the back of this spec changing, then it changed, the announcement changed again. So anyway, the point is that a sweeping statement like that can have massive ramifications.
Yeah. It kind of ties back into the podcast we did on the AI stuff as well. It's like, what if these statements come out that, like, you know, they're obviously look like they're coming from official sources, because that's going to be the point of AI, is it's going to get so good. It's going to look like it's coming from an official source, and then people are going to trade off the back of it. And then when it gets debunked, you're going to lose a lot of money. I mean, people definitely hurt yesterday after that. I know it was only a couple of minutes. I think by the time I had even read the rumor, it had already been debunked. But still, the fact that prices rallied up and back down so
that's
aggressively.
just but I was more getting at, you don't know how many physical deals might have been negotiated
on the back of
that.
Yeah.
All on the basis of rumors. That's super interesting.
Yeah.
This is getting into that territory of like serious ramifications and serious liability from these news agencies to get it right. So it just looks suspicious as well. Like, what, you just made a mistake and it just happened to be a bullish headline. I don't know, but it's all conspiracy stuff. But yeah, I mean, anything else on that point, or generally speaking,
just
about
on
Brent?
the cuts as well? I guess the other news on the back of kind of the cuts is that China now obviously is, for August and September, they've booked 1 million barrels a day of crude coming from Brazil. So this kind of ties into, again, we've mentioned it before, it's like if Saudi keep cutting and cutting and cutting, and actually an interesting kind of link to this is actually in the gas markets right now, where the European ministers are talking about, since Russia have cut gas supplies by so much, should we even bother letting them reinstate those gas flows via pipeline? Maybe we should just cut it there as is, and let's just keep trying to diversify our gas sources, because you burned us once. Obviously there is a massive rally in all those gas prices. It's like, why would we trust you again? You cut, let's just actually now find other sources. Let's not rely on Russia. And it's like, are Saudis kind of shooting themselves in the foot by doing all these cuts now? Because we're seeing China, again, looking to diversify their crude sources, so that 1 million barrels a day now. And then obviously there's this other, well,
their own production. Did you see that Javier Blas?
That it's up again, and so they're increasing their own oil production. They're increasing imports from Brazil, and
that's a key outlet for Russia and the Saudis, right, long term.
Yeah. And then you've got obviously India's in their summer, it's their monsoon season now, so they were, I think 40% of their oil imports were coming from Russia, but they're kind of at max capacity. The the discount as well of Russian Urals are not what they were kind of at the beginning of the year. I think they've gone from like $8-9 down to like $3 or $4, so they can't afford to necessarily be buying that anymore, especially not when their demand for summer isn't that high. So it's kind of interesting in terms of, are they going to eventually just cut so much that they're just going to cut themselves out of the market, that they're going to become sort of an irrelevance? I don't know, what do you guys think?
No, it's super interesting, but actually I think given what you said you're going to talk about, I think we can come back to that, because it's basically the sour market we're talking about in particular, or heavy sour market. So those dynamics at play is what's super interesting. And it's the tale of like two markets, west versus east, or even just sour versus sweet. So anyway, let's get to that. But what did you want to bring up? The geopolitics within OPEC.
Yeah, so within OPEC, I was reading an article this morning from the Wall Street Journal that basically was publishing it was from a meeting that was held in December, where the feud between the UAE and the Saudis kind of got like brought to a head, and that there were quotes from Mohammed bin Salman, who was telling his advisors that he, quote, doesn't trust the UAE anymore, and that he feels that bin Zayed, who is in charge of the UAE, he feels that he has been forced to do something in terms of like further geopolitics in like Yemen or whatever that don't serve him, and they just serve Zayed. And then on the flip side of this, Zayed feels very angry and overridden. And this comes from not only in terms of like Yemen and war and that side of the geopolitics, but in terms of oil, UAE and Saudi have just always historically had kind of different mindsets coming into OPEC, and Saudi has always kind of been able to keep a lid on the UAE, and the UAE has always kind of wanted more production and wanted a greater production capacity. And even now we saw in reaction to the cuts the other day, the voluntary cuts, the UAE responded and said, this is great wisdom from the Saudis, but we're not going to follow suit, I'm afraid. And even further, like a bit earlier this year in March, we saw like tensions bubble up again, and we saw the journal quote the UAE saying that they might actually leave OPEC, which is, a massive thing to claim. And it didn't take long. I think obviously a really bearish reaction in the markets. And then the UAE released a statement being like, yeah, we have no plans to leave OPEC, but it doesn't necessarily completely take it off the board. They're just letting their mind wander out loud to kind of flex their muscle a bit.
To test the market as well.
Yeah, completely.
So
to show how important
things.
they are to the Saudis as well.
True.
Yeah.
True. So many things there like coming through my head as you were speaking. Like, one, the press leaks are getting out of control now, right? And I think again the Saudis were like, well, we need to ban the media from the OPEC headquarters because this is just getting silly. But you can ban them, but like everything's done digitally now anyway. It's not like you need to physically be there. So the leaks are just outrageous. And as you say, like a leak saying we might leave. Ooh, how does the market take that? Even if you were like an executive at a public company, it's the same thing. It's like if someone leaves, the market's going to react, or if something happens, and so you kind of want to know, like, if something big happens, like an executive leaves, how do you release it to the market? How are you just going to have a stock market sell off? It's very similar. This is their asset. Like, they're long this stock, basically. They're long this asset inherently, and they just got to be very careful about it. So it's like this well, that was the first thing I was thinking about. The other thing I was thinking about was, I wonder if there's anything to do with the urgency, because we know about Saudi's 2030 vision. That's very well publicized. But actually, Abu Dhabi, they're trying to boost their financial center. They've got their own aspirations, and actually right next door is Dubai, which is really kicking off from a tourism perspective, or actually no, more of a relocation perspective, right? A lot of oil traders are going there, a lot of brokers, a lot of people in general. Like they're really starting to accommodate like proper tourism there. So, yeah,
just off the back of that, I was reading about that as one of the many arms of where tension kind of originates, and that the UAE feel like they kind of already have their feet in the tourism, and they want to kind of keep that for themselves. They want to kind of be more, quote unquote, socially liberal.
Yeah, I guess it's just the actual possibility of them leaving OPEC, even though they did say they might entertain it. Like, it's a serious thing to leave that kind of organization, because it is oil. And, it's just one asset, but so many ramifications across their economy and other people's economies. It would be a real shock to the market, which means the global markets, which is just, it's like so much there. There's probably so many business dealings and general kind of, political links. So I just think, personally, I think that's very unlikely. But as you said, Martha, like, you at least want to entertain that the threat could be there to be taken seriously, especially if you're not communicating one-on-one. You're communicating via the media, right?
Yeah, and they're not communicating one-on-one. I think they've not spoken in 6 months. Like, there's no like line of communication there, and we can see this in the production capacity of the UAE is increasing to 5 million barrels per day by 2027, which is well above its kind of allowed limit of 3 million barrels a day. So
they've got their own targets. They've got their own,
Be interesting to see Aramco versus ADNOC during the trading windows, going up against each other, bull versus bear. But yeah, it's one thing to say, probably the UAE are just playing their cards. They gotta have some leverage. It's one thing to say we'll leave. It's another thing to actually do it and implement it. So of course, you got and supranational organizations like the EU, NATO, African Union, all of that. Countries, they band together into regional blocks for oil. The OPEC is the equivalent, as a producer cartel. They band together because the sum is greater. The total was greater than the sum of its parts. If I got it correctly, so that's the point of OPEC. So of course the whole goal is to act in unison as one unit to either raise or lower oil prices. And of course, sometimes there's divisions, competing interests.
Yeah.
Not only that, got the
and
price
probably a bit
war.
of fatigue, right? I mean, we've mentioned this a few times about 2022 being such a profound year for the oil market for a number of reasons. But in the middle of a cut and the middle of the most bullish physical market ever, a war, we still managed to sell off in flat price. So not the most amount that could have been captured by the producing nations during that time. So like, that's got to lead to a bit of frustration, right? We were told we go along with this, got hold of the market, got control of the market, we'll monetize, increase production and capture that. And that hasn't happened. So they haven't had time to bring back their production, bring back their market share whilst flat prices being high. So I guess that's leading to a kind of a stubbornness from Saudi being like, no, we are going to keep going. And they've been incredibly stubborn. I didn't think they'd go this far at all. And it's slightly embarrassing for me, right? I was on the Wall Street Journal saying, I just can't see this anymore. It's so bearish. WTI Midland's so bearish. NAPFA's so bearish. The light market overall, we'll talk about in a sec, is just so overhung. This is like going to collapse. And we did see a lot of shorts, didn't we, on the futures and certainly in the dated Brent swap market. So it was about to fall off a cliff. But instead what we got was a short covering rally because I think a lot of people were starting to expect this, yet they still went even further. So super interesting. But my only last point I wanted to make on what you were saying, Martha, is like, again, this press release stuff is just getting so crazy with everyone, right? And you were talking about like finfluencers. I even saw, I don't know how long ago it was, but Xi Jinping speaking to Justin Trudeau and him basically having to translate him saying in Chinese in a meeting in a I don't know, a summit, I guess. So translator him and him. And he's saying to him, like, seriously, like every time you release everything we've just talked about, it's just there's no good faith. Like what, like if you're serious and you want to have a discussion, then let's have a discussion. But you just released everything I said. And Justin's like, well, we're a free speech country and all that. Cool. But like the point is that, like you were saying, this whole communication via the media, that's getting ridiculous. And I know we're not going to start raising conspiracy theories, but the amount of times we've seen headlines come in and then be redacted and then all this and all that, it's just a joke now. Like, and I think it's just so obvious what the industry is trying to do in terms of the producing nations. We know they want the price higher, but you can't on the one hand say I want the price higher, but actually no, we're not doing that. We're just balancing the market because it's just not when you feed all these things through. Like you can't treat, well, you can, but the market has been treated sometimes like an idiot, and I think increasingly so with these like leaks. It's just But anyway, to your point, you want to talk about Brent Dubai.
Yes, Brent Dubai crude. So of course everyone knows you've got the Brent futures, the main benchmark in the world that prices most of the world's oil, but then also Dubai is the Middle Eastern crude oil benchmark. It's pricing more relatively medium to heavy sour crude grades. For Brent, it's more light sweet. So generally, typically, Brent versus Dubai, Brent's at a premium. So the Brent Dubai spread is around typically $3, $4, $5, but this year it's progressively trended lower, and it trended even lower after the recent OPEC cuts throughout Q2, so April, June, and strengthened once again in July. So what typically happens, Audrey did mention before about China buying more oil from Brazil. So that's would be bullish for Brent Dubai, because if Middle Eastern crude becomes more expensive, like you see Aramco raising their OSPs, Asian refiners can always look elsewhere in the world for
provided freight is low enough.
Typically, theoretically they would be going for substitutes, and that would be theoretically bullish for Brent Dubai. And the arbitrage.
Well, that's interesting. So, when you say things, it's like you dissect them, right? So you're talking West versus East.
Sure.
Brent Dubai isn't West versus East. So that's the thing, right? So West versus East is kind of supply and demand, you can say it, I think. Of course you can. But in terms of what price is Brent versus what price is Dubai, or both are priced, their physical differential is set by the weakest crude, right? The cheapest available crude. Cheapest available crude in Dubai is Al Shaheen. So it's a really very bad, not bad crude, but low quality crude relative to, Murban, for example, and the others in the basket.
Sure.
There are quality premiums to adjust for the differences, but Al Shaheen, generally speaking, is Al Shaheen, right? And that's what's setting Dubai. And then on Brent, it was 40s. So that's why the 40s Murban diff was so important, because even though Brent Dubai technically was light versus heavy, it kind of wasn't. It was 40s versus Al Shaheen. And the sourness, at least to some extent, was kind of comparable. Now it's WTI Midland, or at least WTI Midland is involved. When WTI Midland being so overhung and people not wanting it, suggested by the physical differentials being negative, then I know this is long-winded, but at the end of the day, Latin American crude is generally priced against Brent or dated Brent. So the Chinese buy it on a dated Brent benchmark. So you're saying, okay, so they're buying that, so that should be supportive. But then what sets dated Brent? Light sweet. So it's like a weird conundrum. It's not actually bullish.
Well, that makes sense, yeah.
So if anything, them bringing over Latin American crude, sour crude, that can compete with Al Shaheen and weaken Dubai, which can raise the Brent Dubai. So you kind of, you see what I mean? It's just, I'm not trying to be like you're wrong. It's just like the mechanics, the way to look at it. You see what I'm getting at?
Yeah, so you really have to see, understand what the specific crude that sets the grade as well. Now that
when you're talking about it being negative,
yes,
and what does that mean, and where does it go now? It's like, historically we were saying, okay, but it's 40s versus Al Shaheen, and then sometimes if Murban gets too strong, you can bring in 40s, so it's bullish. All these kind of dynamics at play. So that would set the Brent Dubai in a certain range, and the Brent spread's in a certain range. But now you've got a completely different market because of WTI Midland, and we're only just trying to figure out what that means. But generally speaking, it means that if the light sweets are more available because they're not being cut, that's what OPEC cut, heavy crudes are being cut, then you can get a slightly weaker market in light sweet. And that means lower Brent spreads. It means lower Brent Dubai, but it doesn't mean that it's bearish in some. It doesn't have to mean it's bearish. It just means it's reset to the levels that the crudes price it. So if a normal, if WTI at minus 20 cents can still allow for 40s to be flat, and that means the market can be fundamentally bullish. That you have to put a number on what is a bullish market in physical differential terms. Is it flat, positive, whatever? We used to say 40s at minus 30 cents is like a balanced market, because it's about fair for what it is relative to the other Oseberg and Ecofis and all that kind of stuff. So Midland, because it's so competitive, because it's produced so much in the US and exported so much, and they're trying to ramp it up as much as they can with their production, it might just be fair value. Do you see what I'm trying to say?
It doesn't necessarily mean bearish.
It doesn't necessarily, but then at the same time, it is bearish if you can't sell the crude, which is what is happening right now. After the short covering rally, dated being really strong for a period, because suddenly people were like, whoa, we don't want to sell this crude. Refiners were running in to hedge dated Brent. They were buying it all, panicking. Then suddenly a bit more certainty came in, and the oil traders were like, well, hang on a second. We actually can't sell this oil. So they've offered it back into the tendering windows. And now the physical differential, which did briefly go up to flat, have now gone all the way back down to minus 20, 30, probably even lower now. So that nothing's changed from the last OPEC cut. We are still in a overhung light sweet market, defined by low physical differentials, but also because they can't even sell the crude. So how does that filter into Brent Dubai? Well, actually, it just changes. It might mean that we reset lower on the range on Brent Dubai. Do you see?
That'd be interesting, because the current range, the low range is historically low. So what you mean is the implications are this is the low range we're seeing right now. That might be the case in the future as well. It's just going to be almost like,
well, because you're saying it should theoretically the physical arbitrage being open, should support Brent Dubai.
Should support, yes.
And you might get some more buying flows in the paper, but when it actually goes to settle, it's settled by, at the moment, WTI Midland.
Sure.
So, in other words, to make the arbitrage really work in favor of the Brent Dubai, it's WTI Midland that needs to move over.
Yes.
But the Chinese and the Indians and even the Saudis, all the new refiners are all built on heavy sour crudes, right? So why would we buy WTI Midland? Like, we don't want it for the same reason you don't want it, because it's Natfenec and that, you know, we don't want that oil. So that doesn't change just because the Brent Dubai is low. It needs to get low enough to incentivize that consumption.
Yeah.
Which I think is more likely to happen by WAF crude, which competes with European crude in the dated Brent, blah, blah, blah. That goes east. And then more of the local refiners in Northwest Europe and Mediterranean, they can buy WTI Midland. But this is a hope for bulls, and like, it doesn't look like it's happening, right? I mean, there's still all these cargoes on offer. So
it's a very, very difficult one. But at least in Brent Dubai, we are mentioning, so in some past reports, we were bullish in Brent Dubai because not only the physical part, but the financial flows as well, looking at market positioning.
Market was very short, wasn't it? We're trying to catch like a short covering rally in that.
Capturing that, similar to, there was a short covering rally in Q4 last year, and earlier in Q1 in April, the market conditions and the paper market stuff, the conditions were exactly, it was almost mirroring what happened in October last year. So
the only difference being
the difference being the fundamentals.
No, the WTI Midland.
Yes,
yeah.
Technically, yeah.
I mean, I don't know if that's. I'm not going to say that's the reason why it didn't, but that is the only difference. I would say it's just such a like deep cuts by the Saudis that we never thought they would do.
Yeah.
That it genuinely has just smashed it into place. But your whole discussion, and even what you were saying, Audrey, about you were just talking about earlier about the pipelines in Canada.
Yeah, so Q1 2024 is when this is actually supposed to be up and running. So it's been delayed and delayed. So this is the TMX pipeline. So it goes from Edmonton, Alberta down to Burnaby, British Columbia. But basically that's going to be online in 2024. So that's going to send crude coming down from Canada into the US.
Yeah.
So would that mean that they can export even more TI Midland into Europe?
Yeah, but again, this is sour game. So the Saudis, the only bullet they have is to cut heavy sour crude.
This would be a heavier, more sour crude though, coming down from Canada. It's not another light sweet coming down.
No, exactly. Yeah, I see what you're trying to say. So the Canadians like light sweet, they bring it back up and they send back down our bed. So generally speaking, infrastructure being built in the US was always, like in the last 10 years, been bearish. More into Cushing, less that can be easily taken away, more that prices in WTI, blah, blah, blah. What usually happens is the environmental laws get in the way, protests get in the way. Obama was, blocked the Keystone pipeline. That Trump then, quite quickly reversed that. So it's all about kind of looking at that. But then the Biden one is the interesting one. Like, is he going to be pro, or is he going to allow for the pipeline infrastructure to be built?
Yeah.
I think given his aggression on the green policy and he did that first, raised the money first, spent the money first, is a good enough cue to the market that when he then turns around and says, like he did a few months ago, we are going to need oil though for the next 10 years, that can justify the pipeline build because he spent the money on kind of green renewables. So it's possible. So even though it's getting delayed, it's probably more likely that the Canadians, they're also, as a government, more left-leaning. What's his name? Justin Trudeau is like rumored to be tripling the carbon tax. Definitely, an anti kind of oil bias. So it's probably, that's probably more where the resistance will come from. But anyway, the point is that the Saudis are just tightening the heavy crude market. And I think the incremental increase from like Brazil, you were saying, but Argentina as well.
I was going to say, because I'm just reading here that the heavy sour streams, you've got Colombia, Ecuador, and Mexico also down in like Latin America, that they could just start exporting into Asia.
Yeah, no, for sure.
In
and that
theory.
seems to be what's happening, right? As in, like you just said, that they're raising it to find substitutes. Absolutely. But I guess I'm making the point that if the world's supply is a glass of water, like you haven't actually changed the level of the water. All you've done is like, or say you've got two waters, one light, one heavy. All you've done is like you've increased one and you've decreased the other.
Yeah. But
net you're flat. That seems to be the irritating thing that's happening for the Saudis, right? The incremental supply increase in light sweet. And I guess, as you say, like more coming from Latin America, maybe even Canada, to allow them to export more Midland. That's what you're saying.
Yeah,
right?
but my theory is if some more heavier sour grades come down from Canada into the US don't need the Southern America stuff. Southern America, yeah, exactly.
Global export pool gets weighed down even further by light sweet.
Yeah.
So you can cut and cut and cut and cut and cut, but you're just creating this completely inverted, artificially disjointed market. I don't know how long it lasts. You push it right to the extremes, like high sulfur fuel oil cracks, like obviously a byproduct of heavy sulfur crude, been an unbelievably bullish run, and completely logically so.
Yeah.
Whereas naphtha cracks, which are more yielding from the light sweets and WTI Midland, that's ridiculously weak. We really have pushed everything to the extremes on the back of these cuts.
Yeah.
Yet the overall market isn't that strong. I obviously I mean, it's a tough one to call, but it's just I think what we also need to bring up is, like, having said all this crap, good crap, but at the end of the day, we had a short covering rally in Brent. Brent futures is the headline price that most people are referencing. We had shortest at like a hugely short market in managed money one week. Now it's hugely bullish. People are long another week. It's 3 days lagged, 4 days lagged information. So
it's so like, I think we were talking about gasoline in the last podcast as well. We were talking about RBOB futures, and on the back of I think last week when we did our CFTC report, we actually were able to predict how positioning was going to move this week based on EIA cuts, because it's so lagged. You're like, okay, this is already what's happening. So we do our kind of report on a Monday. We're like, we know what the cuts have been last week. This is probably how people will position in the next report. So you can kind of already do some predictions in your head, because it's so.
That's one of the products we do, right? But on that note though, so given it's such a fast changing market this second, having watched this, what I think, do we agree, a short covering rally kind of from like low 70s up to like the just above the 80. It's now since weekend back, we've now had renewed selling in the Brent spreads in like the kind of things linked to physical pricing. What do you think we're going to see on the CFTC then this week on Friday?
I think it could be back shorts coming back in though. Yeah, I really do.
Or longs just basically taking profit.
Yeah, at these levels and being like, sure, happy days above 80. Of course you are. And like once that rumor was debunked, you're definitely going to have those long players, And
I think the producer hedging as well, right? That's for me, if I'm a US producer, I can't remember who it was now, beginning of the year, he's like, Saudi's going to keep cutting, OPEC are going to keep cutting. I'm like, well, yeah, obviously that's exactly what you want. They cut, the price goes up and you make more money. But the key thing is the US producers generally weren't hedging that much in 2022. They got spooked. They got pretty run over by that, by not hedging. This time round, every time you get a rally, it's a pretty sensible thing to go, thanks for the cut. I'm now going to lock in real derivative flow selling.
Yeah.
So we've got to keep an eye on the producer hedging coming in as well, right? Because that will be super, super important to the forward kind of net positioning of the market, right?
And we're not seeing like big rallies up anyway. So even if bullish news comes out, it's not like these big, massive rallies. Like on that rumor yesterday, it's 150. It is big, but it's not like $5, $6, $7 big. So like they'll take it at any level they can once the bearish news comes back in, or at least the not bullish news, the bullish news being debunked. They're definitely going to be happy to take, see $80, thanks very much, and then see what's going to happen the next couple of days. So yeah, I think either flat to potentially bearish on flat price.
It's so hard.
I think crude draws are going to be a big one. We've got the API stats coming out today, and then you've got EIA.
But when you say it's a big one, big one for
that
the fundamental market.
Yeah, it's been the one. No, it's been the one that's kind of been
people are reacting to. No, this is what I'm saying. Like I can see it with the crude traders right now. It's a very tough time to trade. Right, maybe Brent Dubai is a bit more. There's a lot going on. It's directional, but. Chopping and changing where Brent spreads are going, what the uncertainty is in the market, it's pretty tough time to be trading. I would say, it's particularly crude. Best trade is probably not to trade at this very moment in time. But why don't we introduce a bit more like, okay, what do we think the key trades are then? I know we do this on our reports, but brainstorming what we've just said, the light versus heavy stuff, is still a factor, right? But you've had a lot of it priced in. So some interesting ones from what you were saying with the pipeline. We could have a look at, Q1, Mars versus WTI, for example. It's a very niche trade, but that's the heavy crave for Gulf Coast crude. If Alberta crude is going to come in, more heavy sands are going to come in. That should compete. You should see either the market's already reacted or could soon react. That would be quite an interesting one to look at, or like boxes around that. So to your point about Brent Dubai, like even it's Brent Dubai is not necessarily a light versus heavy trade right now, but Mars might be. But any other ideas?
I think the best way is because outright prices tend to be quite volatile with the market really in a wait and see mode, prices chopping around. So in terms from a risk management perspective, like spread trades, box trades, even looking at flies would be a great opportunities on a relative value basis, you know, because you're insulated from the volatility and the outright, but also there's a chance to
keep the same
spot
fundamental
opportunities.
view,
Yes,
but with more like niche kind of positioning.
niche positioning and less volatility, so to protect your positions.
Yeah, but still on the back of essentially a kind of short Brent long Dubai bias, or short light sweet versus Brent versus sour bias. And then you could also do the same, like naphtha has been really weak, but it's actually had like pretty decent rally in the last few days, probably off the back of, again, short covering. So even though you might still be bearish naphtha, is it the best time to trade it given everyone's already sold that crack? But as you say, maybe selling flies, selling kind of boxes into that, it's still, everything still looks the same from a pricing perspective, right?
But also, like, they don't look like they're going to cut runs of gasoline. Gasoline is still so strong as well, so that's still going to produce more naphtha. Could have not put naphtha under more pressure.
Yeah, I think consensus
Even
is
further.
like still bullish gas nap, right? Gasoline versus naphtha. And to Vincent's point, like, yeah, it's still the right trade fundamentally, but how, now that everyone's got the same view, or all the evidence is quite clear, this is where trading gets hard, right? You don't want to put a trade on that everyone else has got on. So, but having said that, you know, diehard fundamentalists, the way to position yourself if you're a diehard fundamentalist is give yourself direct exposure to physical pricing and try and get out all the derivatives. So, you know, flies, for example, are great for that because you're going to get the reaction from the prompt spread. That's going to price, once it's in pricing, it's going to price to real physical cargoes. Whereas the next spread is going to be more driven by flows. So that those kind of trades are going to have to be where you position, like higher percentage kind of trades. Anything else on that front? Any ideas, Martha?
We can be finfluencers.
Finfluencers. Something we'll talk about next time, maybe. The kind of rising kind of lockdown. People starting to realize people kind of abusing media essentially to move markets. Definitely an interesting one for next time. But I think we'll leave it there. Thanks very much for your contribution, guys. And thanks very much, listeners out there. We'll be back next week for more of the same. Thanks again.